The US in February lost 92,000 jobs. But this is likely to be a one-off event because of severe winter and a strike that happened at Kaiser Permanente. Healthcare typically is the primary growth driver for payrolls because it always needs more people. But this time around, because of the strike, it created a huge dip in the overall number. The National Economic Council director said this is what they expect to be seeing because of the tightening of immigration law in the US. On average, the break-even is probably 30,000 to 40,000 jobs a month. Unemployment rate increased, sitting at 4.4%. Look at the chart on the right. It was dropping. Information services and tech, they got a huge hit by AI-related cuts, which brought down about 11,000 in a 12-month trend. Per month, they're losing about 5,000 jobs. Manufacturing will see more cuts. More factories are being automated. Some comments from Jeffries. This perhaps is not the tipping point into having jobs dropping aggressively. It's not. But the risk is still there. On the bright side, wages rose more than expected, currently at 3.8%. This is a decent amount above the overall inflation number. Look at the picture at the right. This shows which sectors are increasing and which are losing jobs. You can see clearly that most of the sectors that are related to AI tend to lose a number of jobs. Other than labor numbers, elsewhere in the US, services and manufacturing sectors are expanding. But it makes sense. When you apply more technology to your services, it improves revenue growth or lean out your expenses. Consumers held up well. However, it's mostly the upper income earners. There are more signs pointing to most of the spending were done by the upper income earners. So next, the potential interest rate cut will be July this year. But what changed is there might be a higher chance of 2 more cuts before the end of this year. Trump has yet to provide an answer regarding the IEEPA tariffs. The Section 122 tariffs will be the replacement. It started with 10% and moved to 15%, which will start sometime this week. Last year, Trump employed a series of tariffs by using IEEPA, and the Supreme Court said he has no legal authority. Trump then used Section 122 tariffs as the replacement, but it can only last for 150 days. Comparing the two tariffs, the figures won't change that much. It's not going to be a shock. On to Iran war and portfolio. The stock markets are selling down now because of disruptions to global trade and oil prices. Historically, well, it doesn't necessarily mean it will paint the same picture for the future. But by using history as a benchmark, 12 months after a new crisis, the S&P tend to gain an average of 2.9%. These are the movements at this picture at the right. 1 week, 1 month, 3 months, and 12 months. The biggest jump is after Gaza war, a 32% jump. And the biggest loss was 34% drop after the Arab oil embargo. But when you think about it this way, the economic position now is much different from those drops that happened years ago. For example, when US invades Afghanistan in 2001, the drop in S&P was close to 27%. And then the Arab oil embargo, which was way longer ago in the 1970s. The world is at a much different place today. The biggest difference you see is how advanced technology is now. Businesses are actively using technology to lean out expenses. This will still maintain the attractiveness of share prices. So when that's the case, S&P as a whole tend to be supported in the long term. The positioning of companies now is much different from back then. And when we look at fear gauge, VIX, the latest number is 29.5, compared to the peak of Trump's tariffs April last year. That was 52.3. So now, markets are still somewhat contained. And when we look at fear gauge, VIX, the latest number is 29.5, compared to the peak of Trump's tariffs April last year. That was 52.3. So now, markets are still somewhat contained. Look at the picture at the right here. All conflicts since World War II to 1940s to now. On average, the S&P gained 2.9% in a 12-month bracket. Then, measuring conflicts since 1979, it also came in 2.9% on average when you look at 12 months bracket, and the number of times the index increased was more than it fell. One more very important thing is consistency. There are many research pointing to whenever you miss the stock market's best days, even when the stock market is in a bear market, most investors will experience some form of loss when they miss it. When you miss the market's best 10 days, over a 30-year period throughout 2024, your returns would have been cut by half. So then lastly, Trump announced a $20 billion reinsurance plan for oil tankers that move back and forth to the Strait of Hormuz. Because of Iran blocking this very important shipping route, oil prices shot up. 20% of global supply came from there, and many oil tankers have been attacked. That's why oil tankers are reluctant to move right now. The entire Euro area is very sensitive to oil and energy prices, and they're mostly very manufacturing and trade-heavy businesses. Things will be bumpier again related to inflation, which will likely hurt overall growth. Eurozone energy supply remains very vulnerable because they're more reliant on liquefied natural gas. And next, expect the European Central Bank to be very vigilant about inflation numbers, which in turn dictates the direction of the decisions regarding interest rates. Asia is also very vulnerable to oil prices shocks. Most countries in Asia rely heavily on imported energy. Other than Malaysia and Australia, most major economies run on sustained deficit in oil and gas trade. And a significant share of Asia's crude oil comes from the Persian Gulf. The disruption at the Strait of Hormuz will put pressure on manufacturing across Asia. Most currencies will see a dip because of inflation, which pushes the attractiveness of currencies downwards because of the drop in purchasing power. Other than high oil prices, trade will also be worsened. It's not just the higher oil import bill, but also the movements in trade might be lesser because it's more expensive now. This gives an idea of the oil flow movements at Strait of Hormuz. Big Asia countries rely a lot on this shipping route. Many Asian exporters have been actively diversifying away from U.S. markets, and Middle East became a good alternative destination. But now there's the disruption in oil. Any prolonged disruption will slow down the trade momentum. At the chart on the right, you see over 90% of Japan and Philippines' oil imports come from Middle East. China is close to 40%. At a glance, Asia seems to be able to absorb the recent jump in oil prices because inflation is starting at a relatively low point. But the question is, how long and high will the prices stay elevated? At a very recent news, Trump said that the war will end very soon. China, at early March, held a meeting that sets the pace for this year. Not all details are published, but the prominent ones are out. China set GDP growth for this year to be 4.5%. It's the lowest target since early 1990s because of deflationary problems and trade tensions with the U.S. They kept two things the same: government budget deficit at 4% of GDP and inflation target at 2%. For them, the 2% is a ceiling. It's a struggle for them to even hit somewhere near 2%. And they commented that the stimulus deployed last year helped cushion the impact from U.S. tariffs. And then they're acting as a mediator for the Iran and Israel. China held phone calls with both counterparts. China plans to issue $188 billion of ultra-long treasury bonds this year. This will support consumer goods trading program again and will replenish capital for the large state-owned commercial banks. They also want to improve their debt stress in their respective local governments. And policies will be helpful to steer the economy for growth. There might be more interest rate cuts and reductions in the reserve requirement ratio, which is the amount of liquid assets banks need to hold.